CSC 2 exam preparation, Chapter 17, mutual funds, structure and regulation. What is a mutual fund? It is a managed type of investment, an investment vehicle, which is operated by an investment company that pools together the contributions from investors and invests them into different types of securities. Think of it as a swimming pool for investors. Everybody puts their money into the mutual fund, and then the portfolio manager decides on the types of securities that it will invest in based on the objectives. The value of the shares or the units may go up or down depending on the market value of the assets within the mutual fund. It is said to be in a continuous state of primary distribution where any purchaser must be sent a fund fax or prospectus. Majority of the mutual funds in Canada are open-ended, meaning they are in a continuous state of distribution. They're always available for sale and purchase. On any business day, you can buy a mutual fund or you can sell it. The net asset value per share, NAVPS, is a theoretical amount of a fund unit holder that the fund unit holder would get if the fund were to liquidate, if the fund were to sell all of its investments within the portfolio at market value, and they collect all receivables and they pay all liabilities, and then they distribute what is left to the unit holders. That is the concept of what is net asset value per share. It is the price for one unit or share. The formula for NAVPS is total asset minus total liability divided by total number of outstanding units. Outstanding units, you might recall, are the units which are bought by investors, which have been invested already, which have been purchased. One of the national instrument, which is a national policy 81102, it says that the NAVPS must be calculated at least once a week. That's a minimum, once a week for mutual funds, except for the real estate funds, which is they can calculate the NAVPS once a year because they need to do an assessment of the property and that takes time and money. So even though still real estate funds, they usually do calculate it on a quarterly basis, and most of the mutual funds, they report the mutual fund NAVPS on a daily basis on every business day. At the close of every business day, there are a group of fund accountants who will calculate the NAVPS. So based on that price, the value of the shares or units may go up or down. So what are the advantages of mutual funds? It is a low-cost, professional management type of investment. Once you invest your money into the mutual fund, there is a portfolio manager. He or she will manage your money for you. You get diversification. Your money is separated into different types of investments all at once. There are many different types of funds available. Every company has 50 to 100 different mutual funds types which you can invest in. Transferability. You can transfer your mutual fund from one account to another, from one mutual fund to another. It's not locked in. So you can easily switch your funds. You can transfer also between accounts. There are different purchase and redemption plans. There are what is called PACs, or pre-authorized contribution plans. You can do $50 a month, $50 a month, $100 a month. You can set that up. That is possible. Liquidity. You can sell your mutual fund at any business day, and the national instrument 8102 indicates that the payments must be made within 2 business days. So if you sell your mutual fund on Friday, you will not get your money on Monday, but you will get it on Tuesday. There's ease of estate planning. You can transfer mutual funds to other beneficiaries within the accounts. There is loan, collateral, and margin eligibility. Mutual funds can be used for buying, for the purpose of using as security for a loan, and margin eligibility. If you have a margin account, if you remember from chapter 8 in our CSC 1, we talked about margin accounts. So if you're borrowing to invest, you can use mutual funds for that purpose. There's various special options in customer service. So there's different things you can do with mutual funds. You can reinvest the dividends also. If you're getting dividends or you're getting distributions from the mutual fund, you can ask the investment company, please reinvest my money. I don't want the money in my account. Just buy me more shares. So that is reinvestment of dividends or distributions. There is a lot of reporting, a lot of documents you can get. For example, annual information folder. And the annual reports have to be filed on CDAR website. If you go on Google and you type in CDAR, you will see that it's public access for all the different filings of all the public companies in Canada. And so you have a good record keeping available for tax purposes. So all these benefits indicate it's a really good investment. However, there's always disadvantages. Nothing is perfect. So the disadvantages of mutual funds are the fees. There are many different types of fees, which we'll touch upon in this chapter. Front end, back end, MER. It is unsuitable for a short-term investment. Usually we say under 3 years, it may not be a good idea, or for emergency reserve, because there may be a sales charge also. Sales charge meaning you may have to pay if you sell the fund. You may have to pay a fee. There is professional investment management, but it doesn't guarantee that you will be getting a perfect result all the time. The portfolio manager may make a mistake and may not invest in the right products, or overall the market may come up and down. You cannot control the market like we discussed in the previous chapter. Systemic risk may still be there. And tax complications. If you buy and sell the funds and you get a lot of distributions, you have to keep track of all that. They're taxable events. And so you do need to keep track of all the taxes for the mutual fund. And it may not suit you for your time horizon.